Good afternoon. I'm Roberto Coutucho, CEO from Ohmresearch. We're continuing our Global Insights Conference in its second edition. Today, I have with us two authorities, two experts on emerging market exchange. These are consultants from First is Gautam Jain, who worked at Barclays for a long time. He's a chief strategist for exchange, for currencies, and also interest. And then he was manager of interest and exchange and currency in the TRG, which is a hedge fund in New York. We also have Michael Harris with us, who's a veteran in emerging markets. He's worked for over 25 years at the Bank of America Merrill Lynch, and he's an individual who was ranked most times in the researches in the polls for the past 20 years. And he's going to speak, or they're going to speak about the dollar, what's going to happen with the dollar globally. And what's interesting to see is that they were both in our conference exactly 6 months back, and they got their predictions right in terms of the dollars and the main other emerging market currencies. Gautam will speak first, and then Michael. So,
speak first for 15 minutes, and then Mike, and then I'll manage the Q&A.
Thank you, Roberto. So what I'll do is I will divide my talk into three parts. First, I will talk about how the dollar has fared this year relative to my expectations at the end of last year when we had this forum last. Second, I'm going to talk about what to expect going forward. And finally, what does it mean for EM currencies broadly and the Brazilian real in particular. So first, let's look at the dollar behavior this year. At the time of the same forum in December last year, if you recall, the dollar had weakened by about 12% from the peak in March. And my view was we could get a little bit more of weakness, but most of the weakness was behind. I was looking for at most about 5% of weakness. Instead, the dollar has traded in a broad range, with the dollar index staying between 90 and 93 this year. So what changed? The expectation at the time when we had this forum last year was for Republicans in the US to essentially maintain control of the Senate. So essentially we would have had a divided government with Biden winning the presidential election and Republicans keeping the Senate. Instead, the surprise came in the form of Democrats winning the special elections in Georgia in early January, which changed the dynamic completely. The market started pricing in another fiscal stimulus. It started pricing in an inflationary scenario. Growth forecasts for the US went much higher than they were before. The Treasury, which was at that time, the 10-year yield was about at 0.9%, started rising, and it kept rising until the end of Q1, when it hit 1.75%. At that time, it seemed like the reflationary scenario had been a little bit overpriced. The Fed sort of maintained its view that inflation is transitory, and you saw the yields coming off from the peaks by about 20 to 30 basis points or so. The dollar, which had gone from 90 to 93 since the beginning of the year to the end of March, turned around and went back to 90. And it stayed there until the June FOMC, when the Fed surprised hawkishly once more. And that's when the dollar started rising again, going back close to 93. So this is kind of what has transpired. What do we see going forward? In general, I'm expecting the scenario to be similar to what we have seen, in the sense that I'm thinking of the dollar staying in a broad range where it has been, unless we get a new driver. So the baseline scenarios for range trading, but the risk scenarios, which could be one of several, the three that I think seem to be the most likely if one of those were to play out. First, the Fed starts tapering earlier than the market expects, which is right now towards the end of Q4, so towards the end of the year. So essentially the data comes out much stronger than we think, and the Fed is forced to hike, or sort of not hike, but taper earlier than the market thinks. The second risk scenario would be the sort of the flip side, which is we get much weaker data, which in theory, looking at how China is going through its cycle and it's ahead of all other countries in the cycle. If we start getting data or growth weakness, then you could see the dollar weakening. The third risk scenario is one of broad risk reversion. Of course, this could happen if there's a hawkish or a dovish surprise from the Fed, but it could also happen independently if, for example, we get a correction in US equities or some other event like that. But all these are, I think, low probability events at this point. The most likely scenario is we see the dollar staying in the broad range for the near term. And the reason for that is the four main drivers that I look at seem to be canceling each other. None of them is dominating. So what are these drivers? First is growth differential. The growth differential of the US with developed markets, which in 2021, US is expected to outgrow other developed countries, with the Bloomberg consensus pointing to 6.6% growth in the US versus 5.3% in broad developed markets. Next year, though, this differential will narrow with both close to 4% based on Bloomberg consensus. So essentially, this is a dollar negative when you look forward. The second is interest rate differential. And obviously, your rates in US are still far higher than most of developed countries, especially with Europe staying in negative territory. But when you look at this last year, the interest rate differential collapsed, going from something like 225 basis points to 150 basis points when you compare 10-year US yields with 10-year European swap yields. This year, though, this has started turning around and it has gone up about 20 basis points. Looking ahead, possibly the US is one of the countries that exits one of the first ones to exit from its monetary easing cycle, accommodative cycle, and you could see this differential rising. So this is a dollar positive, essentially canceling out the growth differential, which I think is a dollar negative. The third factor that I look at is valuation, and here the dollar in real effective exchange rate terms is slightly on the expensive side, just about 5% or so. At the beginning of last year, it was expensive by about close to between 15 and 20%. So 5% is not a big deviation, but nevertheless, it's a deviation and a slight dollar negative. Final factor I look at is current account balance, which is expected to improve, not by much, but gradually over the next few years. So it's a dollar positive. So net, when I look at all these drivers, I don't see any one of them driving in a major way. So I see dollars staying in this broad range, unless one of the risk scenarios that I outlined earlier play out. So next, what does that mean for emerging market currencies? So if you look at the behavior of emerging market currencies this year, for the most part, they have mirrored the dollar very closely. So the correlation, or the sort of the negative correlation of EM currencies with the dollar has been higher than normal. And I would expect a same situation to play out. So if the dollar is in a range, there's not going to be a big negative or positive driver for EM currencies on aggregate. But what we have seen this year, and which I still expect it to play out going forward, is a lot of differentiation in the EM space. What are the drivers of this differentiation? First, these are sort of interrelated drivers, but let me lay them out. First is vaccination. So essentially, countries that are ahead in the pace of vaccination have been rewarded as with expectation that growth will be better in those countries than others. Second, monetary cycle. So the countries that have started tightening earlier than others have had currencies do better because rates have started rising in those countries. Third, carry. The carry is again related to interest rate differential, except there are some countries that already have a high carry. And this to me could be, in the very near term, could be relevant if, for example, we don't get much of anything until the Fed Jackson Hole Symposium at the end of August. We could be in a sort of a flattish carry trade environment. If so, currencies with higher carry, especially those that are tightening monetary policy, could be rewarded. The final one is politics, which is idiosyncratic, and we have seen that dominate in several Latin American countries in particular. For example, Peru just went to an election. It's still, and the soil has been beaten up in expectation of sort of a negative turn in policymaking. Colombia has gone through as well, and Chile is going through it as well. Finally, this brings us to Brazilian real. So if you recall, in December, we argued that BRL was in a binary place. The fiscal concerns that were weighing on the real were very heavy, and unless they are taken care of in the form of some sort of resolution for the spending cap, I didn't expect the real to perform any better. So it had underperformed massively, and I expected that to continue unless we got a change. And that's more or less what happened. The first quarter, the real continued to underperform until you got a budget deal between the president and Congress, which coincided with the very aggressive hiking cycle that the central bank started. So the two factors became very powerful together, and it resulted in the real catching up with emerging market currencies, which it had underperformed last year to a great extent. Where does it go from here? When I look at that gap is about between 5 and 7% between the real and the rest of the emerging market currency space. I think that's where the rally in the real is capped. So if we do get a supportive environment or a carry environment, you could see the real continue to sort of try to close in that gap. The tricky part for real is the return looks reasonable, but on a risk-adjusted basis, it doesn't look so good. The volatility of real is almost 3 times that of the emerging market currency basket. If you look at a diversified basket, they typically have volatility about 5% versus 15% for the real. And you have genuine risk looking ahead in the form of the election next year, as well as primary balance staying in a negative territory, which means the debt to GDP is rising. So you have genuine risk. But if you do get a supported environment, you could see the real doing relatively okay and amongst the better currencies in the EM space. I still think on a risk-adjusted basis, there are other currencies that are better. For example, the Mexican peso I like better than the real. So I would stop here and pass it on to Mike.
Thanks, Gautam, and welcome, Mike.
Thanks, Roberto. Thanks, Gautam. So my thesis generally about the dollar is one that's quasi-contrarian. And I say this generally because everyone usually focuses on the idea when you're raising rates, that's good for the dollar. And historically, always the case with most reserve currencies. My view is since the new normal and since central banks have become so relevant to anchoring the bond market and distorting the bond market, that we're in an environment where when central banks are in a position when they're hiking historically, that would be deflationary. So even though the shorter term yield is rising, it brings the long bond yield in immediately. Now, because the short term yield has anchored the long bond to such a large degree, when you do have moves in the shorter term rate, it can unsettle the long bond. That's broken again just recently, which I think is super interesting, but that's been my general framework. Until we can safely say that central banks' short-term policy is no longer anchoring the long bond, we need to think in a contrarian way that actually the initial rate hikes, until you get to a degree which is perceived as more normal, can actually be quite destructive for the long bond. And as anyone who invests in emerging markets knows, you don't want to own a currency if you don't want to own the bonds. And that's why usually the dollar rallies when they raise rates, because it is deflationary and it works for the bonds. This is a time when actually, having spent all these years covering Turkey, which only scrambles to raise rates after the country has been punished, you need to be in a situation where you're thinking about, do I want to own the bond? And if you want to own the bond, then you want to own the currency. So to me, this is very much about a call on the long bond. Now, what's been interesting recently is as the shorter term rates the Fed has become a little more hawkish and people have become a little more convinced that the Fed is going to act sooner, the long bond has come in quite dramatically in the US. So is this a reversion to that historic pre-normal environment? If so, then any Fed move is going to be positive for the dollar. I would argue, though, that the short-term yield is just, and the Fed is distorting the longer-term bond market. So what I think we're seeing actually now is the market is fearful of a correction. I think the market is effectively saying, with the move in the long bond, the market is effectively pricing in a Fed mistake. When I say that, I mean a mistake by hiking too soon and slowing down the economy themselves. It's pricing in a COVID resurgence, which is obviously the Delta variant. You've seen Fed governors today talk about that as a concern of theirs. But effectively, both of those mean that growth is going to disappoint, one through a policy mistake and one through just COVID continuing to come through. Both of those are deflationary and both of those are GDP negative. The other is, of course, a geopolitical crisis. That usually is not something that the bond market preempts. It usually responds to it. And you have that flight to safety. So I don't think the markets know that China's invading Taiwan in the next week or something like that. So, but that could be another, in theory, driver. And sometimes you do have the awareness of an issue, as Bill Ackerman proved regarding COVID, before the general market knows it, because you get access to information that's coming through channels that are generally not public. But my favorite theory, though, is that it's effectively, we're in an environment where equities have done fantastically well for such a long time. And we all know that at some stage you have to have a correction, and we are fatigued. We have had a tremendous year. The amount of issuance that has hit the market has been phenomenal, partially because of the productivity of all bankers. They don't say no to any deal now because basically they all have time because they're not traveling and they're sitting at their desks. And every company wants to issue into this because they see it as they don't see the clarity in terms of the longer term window. They see it as a historic opportunity to issue. So it's been a phenomenal market. My guess is everyone wants to go on holiday and people want to de-risk during the holiday, during the summer holidays. Throw in the fact that there's all this Fed uncertainty, and we all know that hedge funds tend to work in tandem, right? The macro guys all want to be in a position where they can go after something at the same time. So I have a bias to thinking that what we're seeing right now is a de-risking in anticipation of very choppy markets and maybe a meaningful attack on the equity markets, in which case what we're seeing with the long bond and then the dollar is a flight to safety. But it's not a big flight to safety because it's in anticipation of a rotation, and it's probably just going to be short-lived because we're not changing the dynamic. So I actually think the next 1 or 2 months of the summer, when volumes will probably be much lighter, because when people can finally take a vacation after all this time, they are going to shut down. They want to de-risk for the summer more likely, like they tend to at the end of the year. I think people are going to de-risk for the next 6 weeks. And if you're doing that, you're moving into the long bond. That helps the dollar. It probably means equities are a little choppier. If equities survive this, then I think we actually have quite a decent return effectively to risk back into equities as we move into the latter part of the year. And I think that could end up being, as the long bond sells off, I think that could be dollar negative and emerging market supported, both because of the move back into risk and the fact that the if you don't want to own the US bond market, because I think if the only reason you would own the US bond market right now is if you are super bearish or super cautious at these sorts of the longer term rates. So effectively, I would view the bond market as uninvestable unless you're not constructive at all in terms of where the world or where the markets are going over the course of time. So my guess is we're going to get a nice positive move in emerging currencies once we get through the summer. But I would hedge on a 2-month view because I think if we're going to get chopped, if we're going to get pain, if the S&P decides it wants to fall 15%, it's going to happen over the next 6 weeks or so. So buy some protection against that. Think about, you know, the flight to safety, the positive dollar component, the negativity that would have for currencies on a 6 to 2 month view in the emerging world. But as we move beyond that, that's sort of you know, and that's, you know, a lot of times you get those 10% corrections in markets. So this is not a thematic change. It's not a view that the world's going to go to pot. It's just a view that this long overdue correction, they finally have a framework where it could actually materialize. So the second, though, issue, of course, a much greater issue for the dollar where it's headed over time is obviously inflation and the Fed. And you know, I think all of the lagged inflation that we've seen, I mean, I don't know who on this call is trying to book a holiday in the US this summer and booking a rental car, but I'm literally renting a car in a small town in Maine and driving all the way to Washington, DC to save probably about $3,000 in rental car costs. I mean, it's absolutely insane. And you know, I was lucky enough to have bought Avis last year at this time, but stupid enough to have sold it after it doubled in a month. But this is just a situation where demand is shifting to a different level. Inflation is about a reduction in purchasing power. Do people feel poorer today in the United States than they did a year ago? Absolutely not. So then the question is, if you don't feel that strain and you don't have, when the Fed talks about inflation expectation surveys, people in the US and Brazilians will understand this statement. People in the US have no idea what inflation expectations are. If you ask companies or individuals, what do you expect inflation to be? Either they're very sophisticated and they have models and they're just taking a view based upon the model, but in terms of embedded inflation expectations, I must get a 5% wage increase. I must get an 8% wage increase. That doesn't exist in the US. You don't have this huge amount of linkage between trailing inflation, backward-looking inflation driving forward-looking wages. So this is really, I think, a story about the labor market tightness, and I think the Fed is sending an interesting signal. They're saying very clearly, Powell is super clear. He says there's all this uncertainty and no one knows for sure. But one thing he's saying with conviction is that the US labor market is going to be very strong in the future, which I think is a telling statement because it means that they're going to be hiking and effectively tapering and hiking sooner than the market expects, if he really believes in that statement. And the number of times he said it in his last press conference was overwhelming. So on balance, I can see a scenario where the Fed is hiking, but I don't think they'll be hiking because inflation is out of control. I think they'll be hiking and normalizing, not to really slow the economy, but to send a signal that we don't need this excessive stimulus to get the economy going. The Fed policy as it's built today is built for a shock in the markets that we faced last year. That shock is done, and the Fed has to normalize. The problem is there's all the politics associated with it, but there's no one in the world, I think, that expected this degree of fiscal support to come and rescue the Fed as the only driver of US economic growth, as it had been arguably for quite a while. So I'm in the transitory camp, and I think that means that the dollar is broadly neutral. If the Fed is actually scrambling to slow the economy and to fight inflation, that's super deflationary, that's super bond positive, that's super risk aversion, that's terrible for emerging markets. I think growth is going to run. Inflation is not embedded in the US. We're not going to see these wage increases for white collar workers. Lower end of the spectrum will get it, but the minimum wage workers in the US have a wage that's 32% of the median wage. They're not going to drive overall inflation if they get a 10 or 15% wage increase, because they're moving back into the service sector where people are more reluctant or more price sensitive about working. It's when the white collar guys all think they're going to get a 5% minimum wage increase, and we have a problem. I don't think there are many white collar workers in the world right now that feel entitled to a wage increase just because we've seen some of this inflation. Everyone feels a lot better off who's kept their job and been productive this last year at the white collar level and I don't think they feel like they're in a position where they can demand those wage increases. So I am on balance, I think that we're going to have a pretty decent environment for emerging market currencies as we move in beyond the summer, but do please hedge in the interim. A couple other comments I'll make. I'll move into a specific comment that Gautam made regarding that divergence and effectively focusing on the countries that have the high carry. I've been covering, and I'm saying this usually, I'll say this because I think it's a very, very worthwhile trade. I'm communicating to people that I think the Turkish lira is going to be one of the best performing currencies in the world. And the interest rate's 19%. I think it's going to appreciate in nominal terms. So I'll run you through that reason. And it's not just because they're already hiked and they start with a very high rate at 19%. It's more because, one, the market absolutely hates Turkey. I mean, with a passion. And because when other currencies were appreciating, Turkey wasn't because they fired their central bank governor. But the irony is this central bank governor inherited a policy rate that the market liked. And so the low bar of expectations for him is he only doesn't need to cut. There is no need for the Turkish central bank to raise rates. And that's an interesting situation to be in. There's so much pessimism about Turkey, they just assume he's going to cut. But you know that's going to be punishing because the market's on a hair trigger in terms of punishing the Turkish lira. And I think this central bank governor and Erdogan realized that. But the bigger part of the call is effectively that Erdogan has been on a permanently short-term political cycle for the last 7 years. Every 6 to 12 months, he's had an election event. He thought he was going to an early election this year, if you ask me, and I think that drove his behavior. And now he realizes he's so deeply unpopular, he doesn't have a prayer to go to the electorate before 2022, late 23 when the election is planned. So we have a weird environment where Erdogan is actually taking a longer term view for the first time in the last 7 years. Today, he just backtracked on the firing of a rector at a major university. He's calmed his relationship with the US. My argument as well, the central bank is sort of a proxy for all of that irrational geopolitical behavior because it's viewed as a war on markets. And for the same reason, he's normalizing policy because he doesn't have any election urgency. He gets no electoral net present value from attacking the central bank in this environment. So I think the central bank has cover to keep rates flat. If you think 19% is a good enough yield, then my guess is the Turkish lira is going to make people a lot of money. I would stress, though, it's done well in the last couple of days, but I would stay on balance the same risk. I mean, if we go risk off, no one owns it, so it won't be punished as much as other currencies, but you still broadly want to hedge for that risk I talked about over the next 6 weeks or so.
That's great, Mike. Thank you. So let me start with the questions. Galton, a few days ago, you published a report, on your currency dashboard, about what the reserve requirement decrease, in China, what that had, the impact that had in other emerging currencies. And there was an interesting article that I also read on Bloomberg about, the Chinese. If you look at the Chinese yuan, and if you deflate it by, the wholesale inflation, it means that the companies have lost competitiveness. So by that measure, the yuan would be as strong as as it was in the recent history. So meaning basically that they cannot stand a stronger yuan from here. Do you have a view on that? Because that can have other implications.
Yeah, certainly. I think I saw that article as well, and I think it's a pretty interesting way to look at it. Typically, when you look at real exchange rate, you're looking at it in terms of CPI. So what they did was they looked at it in terms of PPI, which has been, in the case of China, PPI has been much higher than CPI. Of course, it's not clear why CPI has been so much lower when PPI is going up. But in any case, they looked at PPI, and based on that, the currency looks very expensive. To me, either way, when I looked at the fact that they went ahead with a surprise, very quick, very preemptive reserve requirement ratio cut, there is obviously, sort of there are two narratives, right? So which is what I wrote in the book. One is they're just being sort of careful, just taking insurance to make sure they don't get a dip in the second half of the year. First half, growth has surprised on the weaker side in China, right? They're ahead of other countries in terms of this cycle of when they went into the pandemic and when they came out. So they're ahead, so they are seeing some signs of slowdown. The more negative narrative that's also kind of sort of freaking people out a little bit is one of, what is it that they know? In the sense that is the weakness ahead worse than what seems like? I don't think that's the case. I still think we're in the first scenario where they're just kind of taking insurance, making sure they end the year with the growth somewhere between 8 and 9%, which is where most of the forecasts are. Having said that, to me, irrespective of which scenario you are in, the renminbi or the yuan has been one of the best performers since last year amongst emerging market currencies. So it is toppish anyways. If they're in a situation where they're concerned about growth, this is not a time when they would be trying to engineer sort of more appreciation of the currency rather than the other way around. They'll try to make sure that the export side doesn't lose out too much, especially if they start getting a little bit concerned about demand, external demand from other countries around the world. So to me, either scenario that plays out, I don't think it's positive for renminbi. That's why one of the trade recommendations I made recently was long Malaysian ringgit against renminbi, because to me, that's one currency where pretty much in most scenarios see weakness. Having said that, to your question, if we are in the second scenario, which I don't think we are, if we are, then the point I was making was that's very negative for emerging market currencies, because the renminbi has outperformed the emerging market space. But if it starts going down very quickly, there's no way the rest of the emerging markets currencies don't go down as well. So you could be in that scenario, or, if you're in that scenario, that could be negative. Net, I don't think we're there, so it is slightly negative, but I don't think it's very negative.
No, that's great. Thank you. No, I now have a question for both of me. I'll go with Mike first. And it has to do with the CPI this week. Of course, there were a lot of jokes because it's once you start adjusting things, and okay, you take this out and take that out. You can get to to whatever number you want. It's like an equity analyst doing his adjusted earnings calculation. Just to say that he's got the estimate right. But in this case, I saw some quite interesting comments, and one of them was that there's quite a big dispersion in the CPI, and about most of the move was in only 10% of the items, if you take that out, the CPI would be 0.2%. So I want to ask you both, starting with Mike, if you agree with that, and if there's anything else to be said about that CPI print that would either bring the tug of war of the transitory, non-transitory to one side.
Yeah, I think there's a lot of focus on used cars, and I think that's sort of that's convenient, because actually used car prices will fall at a certain stage. And so to me, it's less about that than it is what is rising that is more permanently rising. I think food is the key, because that's what people effectively have no choice in terms of spending, and everyone faces the same decision. Whereas a lot of this is selective. Okay, it's wrong to say you can avoid buying a used car in a given year, but there is an element where I'm sure plenty of people who otherwise would have decided that they're going to do something in the car market are not for the time being, and just getting their vehicle fixed. And as the price of the mechanic going up tremendously, my understanding is at this stage not in a meaningful way. So on balance, I think the focus on the actual prints is much less relevant than understanding where forward-looking inflation expectations are going. And I'm super sensitive to this, because everyone looks at central banks for leadership, but wage policy is not in central bank control. But what I would like to see is central banks understanding where wages are going. I've been a very frustrated strategist covering Turkey for 25 years, amongst others, when the Turkish central bank has never written a piece about the wage impact on inflation. They've never written a piece about the minimum wage increase impact on inflation. And they've done that presumably for political reasons, but the US should be telling us very clearly, the Fed should be telling us very clearly, look, we think X% of the workforce will have a backward looking because of pensions and because of government and civil servant and teachers. They will all see a wage increase corresponding with last year's inflation plus something. So we're actually going to get inflationary wage increases from X% of the population, but 80 whatever percent, 90%, we're not worried about because of this reason. So they should be doing that level of detail. There was a good piece from, I think it was Freddie, one of the housing authorities, I'm confused right now, but where they talked about the lagged impact on rents from house price rises. And that's super important because we don't care about what happened. Transitory just means it's done and we move on. If we have negative prices because used car prices fall, then the Fed looks great. But if we have elevated prices, the key is, do they keep increasing across the board? And does it lead to rising fundamental expectations, meaning people have to get a wage increase to compensate for that? There is no way people feel worse off, as I said, as of this stage. It is all very selective, associated with reopening trades and where we had inefficiencies in the market last year. I'm not a genius, but it didn't take much for me to think. I bought a used car in April of last year. It was super obvious that was the time to buy it because everyone was going to be going, no one's going to be taking public transport. There's a glut in the markets. And so you get this dispersion. I was discussing with a used car manufacturer today, and they took a huge hit last year because they dumped inventory, right? And so part of that increase as well is just base effect is so incredibly low from this time last year because it was a buyer's market this time in used cars, and now it's just shifted. So it's a long answer, but I would say this: there's the people are politically clinging to what makes sense for their inflation narrative and the view that they're transitory or they're worried about it. I have not seen a good piece of research that really talks about how this is going to fundamentally impact wage expectations and rent going forward. The rent one was interesting, but the Fed's not talking about it. And that to me is all that matters, because if people's food bills going up, if people's rent bills going up, their wage bills can ultimately go up. Otherwise, they're going to feel a lot poorer. So I think I'm pretty relaxed because I'm pretty confident that in the US, I need to do this research myself, but I'm pretty confident in the US that there's very little backward-looking inflation-driven wage increases. It was interesting that BlackRock gave an 8% increase to all their white-collar staff, but that was just because they're flush, right? It's the K-shaped recovery, and they're huge beneficiaries. I don't think it's because they're rewarding their employees for the sacrifice. But if every white-collar business decides they're going to give a 5 to 10% increase to their employees, we're going to have a problem. But one thing the Fed should be doing as well, for what it's worth, I think they should be basically targeting the housing market like the New Zealand central bank has done, because that is clearly an area where everyone is putting their money because they don't know where else to put their money. And that is going to have an impact on rents as we go forward. So that's something I would have thought the Fed should be on top of. So I'm sorry I don't have a more direct answer, but I do feel confident that most people that are commenting on something that's backward looking, and that's not why we worry about inflation.
Yeah, no, that's great. Gautam.
Sure, I think I broadly I agree with what Mike is saying, in the sense that to me wages are the most important driver of inflation expectations, and that's where I feel like the data that we're seeing has and will have a lot of noise the next few data points. And I'll go into a little bit of the different reasons why that would be the case. But wages is the most important driver. And that's where I feel less concerned about inflation, partly for some of the reasons that Mike highlighted. But if you think very broadly, there's still 3 million plus people out of the labor market, right? Compared to when we were at the beginning of the pandemic. So for me, the output gap is the labor slack that needs to close before we start getting concerned about, or very concerned about inflation. The wage increases that we're seeing, again, as Mike was saying earlier, is mostly at the low end, which is related to one-off minimum wage increases. These are not increases that would cause disanchoring of inflation expectations. So I'm less concerned about that. Now, in going to the specific data release, it is going to be very tricky, because if you think about it, any year-on-year comparison is fraught with a lot of problems because the base that we're coming or looking at are the periods or the months when the pandemic was at its worst, right? So it is very hard to do a year-on-year comparison and have any confidence on what you're seeing is necessarily inflation or not. And also, the pandemic itself impacted different sectors differently. So, for example, if you, and I think Steve Englander or somebody did this analysis, that if you look at the parts of the economy that actually benefited in a way from the pandemic, which is related to health services and so on, there you don't necessarily see inflation or signs of inflation, because those were doing normally, if anything, doing better than normal same time last year. But if you start looking at things like hotels and airlines, of course, or car rentals, of course, you're going to see a massive inflation because those have gone down this year. So you would see, things going up by infinite because there was no demand whatsoever for any of those things. So I think it's fraught with problems if you start sort of breaking it up. To me, when I look at the big picture, it's very similar to what Mike is saying. I would focus broadly on wages and whether they have started going up and whether that has become sticky. That's when you have to be concerned. I don't think Powell and the Fed is looking at it very differently either, because they seem to also have the mindset that, in a way, they actually like the fact that finally this is one cycle where the blue-collar workers are seeing wage increases, thanks to both the fiscal and monetary stimulus happening at the same time. This is an issue that Yellen has talked about for many years. Powell has emphasized it, so they're actually seeing that. And Biden, the president, is also, I don't think they are unhappy with what they are seeing. So I don't think that is something that they regard as inflation. That's why they keep emphasizing the transitory part. Having said all that, of course, we are in a place where the data is very difficult to read into, and you don't want to be in a situation like in the 70s when, once again, people were sort of throwing out things, components or the categories within CPI that they didn't like, and ultimately that turned out to be the wrong approach because there was underlying inflation, which ended up being much worse than people were expecting at the time. It could be that we're in the situation. I don't think so. My view is we're not seeing real wage pressures, and therefore I don't think we are in serious inflationary environment.
No, that's great. And what you guys mentioned about the link between past inflation and expectations was something that took Brazil a long time to get rid of. People call it inertial inflation or inflationary memory or whatever they want to call it. But every time there was an anti-inflationary plan in Brazil, it was difficult to get rid of that, and you don't have any resemblance of this in the U.S. The other question is, I want to ask you both, if you have a view on central bank digital currencies. Or Gov coins, as they said. We had an interesting panel on the theme on Tuesday, and just kind of an open-ended question. I mean, if you have any views, either one way or the other. So starting with Mike.
Sorry, I don't have a strong view on digital currencies in the sense that for government digital currencies, aside from saying that clearly this will be like reverse privatization, because effectively it would be the central bank disintermediating the banks if they allowed everyone to effectively bypass the bank. So to me, these digital currencies that they're thinking about launching partially are a response to the crypto, where they want to effectively respond to something that I think they're clearly extremely worried about. And practically, I think, though, that they realize this is the government getting into a place where they probably think the private sector should be more active. And unless unless you're a country like South Africa, where you're trying to say, well, we need to break up monopolies and to have more, production of steel or whatever it ends up being, and have the state involved, I don't see that. So my bias is that this is getting a lot more attention than it deserves, because it would be very, very, unique effectively for the central banks to create a mechanism that could, I would say more than, marginalize, but actually threaten banks.
Mm-hmm. Okay, thanks. Gautam?
Yeah, my view is not going to be very educational either. I'm sure the previous panel that you talked about, probably they had better, stronger views. To me, it almost looks like the central banks are sort of trying to catch up with the market by attempting to study or look at ways to do, sort of issue sort of digital currency if need be. But I don't think they are also taking, and I'm talking, not a country like El Salvador or something like that, but most central banks in the poor countries, I don't think they seem to think it is a path that they need to go down. But at the same time, they don't want to not be looking at it and look like they are behind the curve. So it is an attempt to sort of see or ensure that a cryptocurrency doesn't become the currency of the world. If it does create problems for them. I don't think they have the view that it does, because right now it's primarily being driven by sort of different agents who have different sort of incentives, risk reward kind of incentives. So it doesn't threaten them as much yet. If you think broadly, most countries were heading towards different forms of digitization anyways. Maybe they just kind of add another layer to it. Is kind of how they are thinking about it. I personally don't think they're very far ahead as yet. So that's kind of where it is.
I'll just throw one thought in, Roberto, if I can, is that I think where they were nervous was Libra. Facebook effectively was was going to create a mechanism that was effectively neutral from a currency perspective. It would diminish. It would, when we talk about the euro wanting to gain more strength relative to the dollar as a reserve currency, Facebook indirectly would have achieved that through Libra, because it would have had a balanced, stable coin effectively. And I think the reason that Libra backed away, and it was because of government pressure for fear that people would save in Libra, and people would invest in Libra, and people would transact in Libra. And so the central banks wouldn't lose control over the money supply, because it would ultimately be backed by currencies, but the US would have lost its geopolitical strength associated with dollar dominance, because that would have been a threat to the ubiquitous use of the dollar, in my opinion. So I think where they see the threat, they go after it quickly and firmly. But I don't think Bitcoin, I think, is more something they can't control, but it's not a threat in terms of the global monetary system. But it's more just a mechanism for so much opaqueness and tax evasion, and we see it with all the ransomware and stuff like that.
No, that's great. And now that you talked about geopolitics and U.S. The power from that comes from the U.S. Dollar being the main reserve currency. In the panel before, we were talking about energy transition, and you saw what the European Union has done. They want to establish themselves as the leader in energy transition and in the carbon market. But the question is not so much about the EU. The question is, I have a view, and a lot of people do that. U.S. power and the fact that the U.S. dollar is the dominant currency has to do with oil, right? So the oil was the world runs on oil, and you can only transact oil in U.S. dollars. That explains the geopolitics of the Middle East and everything. So if we go, let's say, it's not going to happen overnight, but let's say if in 10 years things start to look differently, do you think that affects the dollar as the main reserve currency? Because one of the aspects of the last panel was, okay, there are also geopolitical aspects about this energy transition. So they're like the hotspot for the Middle East. Now you have to see where they produce copper, zinc, lithium, and so forth. So how does that energy transition affect the dollar?
I'll take a stab at that. I think that's a phenomenal point. I'm a believer that it's the borrowing in dollars and the saving in dollars and investment that's the bigger driver. But yes, one of the easiest ways.
that comes to me. People save in dollars because they need to buy oil.
Yeah, no, it's a great point. I think it's a super point. And so that will definitely change the equilibrium to a degree. And as long as I'm a fan of the U.S. actively. I think this geopolitical strength of the dollar being ubiquitous has hurt U.S. manufacturing. I think it's been one of the drivers because it means the dollar consumers have more spending power. The dollar is stronger than it should be. Government borrows cheaper, and it's ultimately current account and manufacturing negative in the U.S. So that's a gradual transition because it doesn't mean people are turning against the dollar by changing their repositioning, but it means there's an organic, natural economic driver that's more gradual that leads to this. For what it's worth, though, I also think we're going to get I think we're beyond peak oil from a volume perspective, but by definition, because if this is real, which it seems to be, then you're not going to get the level of investment that you need. So pricing will be elevated, probably relative to what it should be as this transition is happening. And it's only when you really get to the stage where the volume disappears. Then it'll overwhelm. So it could be an interesting phenomenon if that happens quite quickly at the end of a 15, 20, 25 year cycle. But between now and then, we may be, post this COVID bounce, we'll probably see peak oil from a volume perspective, but I don't think we'll see it from a pricing perspective necessarily.
Gautam?
Yeah, I think you're right that some of the savings or a big chunk of the savings, especially in countries that import oils, and the demand for dollar comes for the imports of oil. Having said that, some of the things you mentioned, some of the metals you mentioned, copper, lithium, all commodities are quoted in dollars. So some of what you will lose in oils, you will make up because the demand for copper is supposed to go 2 or 3 times from where it is now by 2050, right? So some of it will be made up. So I don't necessarily think it's completely just on the negative side. It'll offset some of it, but yeah, definitely some of the luster that dollar has will be less. Now, when I think, let's say it is less from the perspective dollar becomes, if you start thinking broadly, will it become stop being the reserve currency? Then I have a harder one to deal with in the sense or which currency is going to take dollar space. I don't know. So even if you see that equation change a little bit, I still think dollar will stay as a reserve currency.
Hey, Roberto, can I just say one thing? It's just a message for anyone here who's in a position to do this. Yeah, I think it's insane that emerging market countries and emerging market commodity producers borrow in dollars. Because when the dollar is strongest, your commodity is at its lowest, right? And so you're doing it because you're lazy, and you're doing it because that's what the banks offer you, and it's the status quo, and you don't want to be a hero. But you should all be borrowing in a basket of reserve commodity-driven currencies. Never borrow in the dollar, borrow in the Canadian dollar, the Aussie dollar, anything that's correlated with your currency but gives you a low interest rate associated with reserve currency would be the way I would go, as opposed to the part of this, it's not just because the dollar.
That's a great point,
and a basket of emerging currencies. I think that's what Libra would have been fascinating for, because no one, if you were at that stage in 15 years, every emerging company would have been borrowing in Libra instead of dollars, just because it was much less risky, more than anything else.
Yeah, so I mean, this would be kind of a basket of G10 currencies that are commodity related, like the Swedish krona and the Aussie dollar and so forth.
Yeah, Canadian dollar, and then you can also throw a basket of some emerging currencies where at least they might have higher interest rates and inflation, but at least they're deep markets, so there's less volatility. South Africa doesn't raise rates a lot, for instance, just because of the currency weakness or whatever. So I'd like to see that, but I think too many companies would feel awkward being the first ones to tell investors why their earnings missed because the Canadian dollar or the Aussie dollar moved.
Mm-hmm. No, fantastic. I mean, there was a great discussion. We just 4 minutes to go, so I'll ask both of you for your closing remarks, and I want to thank you again. It was an honor, and we hope to repeat in 6 months' time. or if not before. So I would like to pass to Gautam now, and then Mike for 2-minute remarks.
Sure. I would just go back to one point that I made in my opening remarks, which is differentiation. To me, what I found this year to be very good is for generating alpha. It has been a great year. And the reason it has been like that is because of this volatility that we've seen in US Treasury yields. Primarily, that has been the main driver of volatility in all other markets. And because of that volatility and the cycles that we've seen, we've had many opportunities on both sides. I expect it to continue. So in a way, what sort of our discussion has been, there's still a lot of uncertainty ahead. And to me, I won't necessarily look at a currency against a dollar necessarily. I would look at a lot of crosses within emerging markets because there are a lot of stories, a lot of differentiation to be captured there. And I see the environment as very kind of very nice from the perspective of generating alpha. Even if the big beta of the dollar is unpredictable, at least that part is it looks very good.
Great to know. Thank you. And Mike?
Sorry, Roberto, thanks for having me. I appreciate it very much. It's a pleasure and honor to be here, and Gautam to share the platform with you. I love hearing your views. So my last word is what I've already said: hedge over the next 2 months, please. Take some sort of exposure that allows you to be in a position where if the world gets really, really ugly, you'll be sitting with a smile on your face. Go long the Turkish lira in size. Be a little heroic. No one is. And if you do borrow in dollars, and you're not a real dollar earner, and just because you sell commodities doesn't mean you're a real dollar earner, please borrow in something else. Thank you.
That's fantastic.
Let me just quickly thank you, Roberto, and Mike as well. It's always good to hear Mike, and especially his comments from December. I remember, so it was good to relate to that. Thank you, Roberto, for the opportunity as well.
Thanks again, and we'll speak soon.